The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 2nd of May. Welcome back, Jeremy. Good to have you here.
Yeah, hi Gareth. Good to be here.
It's been a normal length week this week, and we've got a bank holiday weekend coming up. So the sun is shining where I am. Hopefully that will last for at least some of the holiday weekend. On which note, do you think the macro backdrop is becoming a bit more bright and sunny, a bit more predictable?
Well, yeah, I think probably it is, particularly from a UK perspective. I mean, this week we've had BlackRock's Larry Fink highlighting the attractive value on offer in the UK stock market. I sort of likened it to battle-weary UK investors are sort of unsure how to react to such good news, in the same way that maybe Millwall football supporters hearing praise for the footballing qualities of their team.
Okay.
And then on top of that, we get JP Morgan's Jamie Dimon saying he endorses Rachel Reeves' economic growth policies. Although, as best I could tell, he didn't actually explain what he thought her growth policies were.
Okay.
It does sort of feel a bit like a coordinated plan for the world to be more optimistic about the UK all of a sudden. So, yeah, I think we should take the win when it's offered to us.
Positivity from wherever it comes, absolutely. And so what else is going on, I suppose, on the broader landscape that might lead to this newfound excitement about the UK investment opportunities?
Well, as ever, there is lots going on. I mean, Donald has achieved the greatest first 100 days of any president in the history of the world.
Apparently, yeah.
So, yeah, we should all give thanks, although investors are sort of being left counting the cost, but that's a minor detail. But yeah, things do seem to have calmed down. Gold has fallen 7% from its peak 2 weeks ago. Meanwhile, it's more sort of risk-on digital cousin Bitcoin is up 14% over the same period. And that's sort of been helped in a better risk-on environment by okay, and in some cases better than expected, results from the larger US tech companies, the Mag 7. Alphabet, for example, had a Q1 results that stimulated quite a risk-on rally all round, really, across the tech names. But Google in particular, amidst its quite upbeat results, just nonchalantly included a share buyback plan that was valued at $70 billion.
Wow.
Which on its own would be a major constituent of the FTSE 100. So it kind of makes you realise the huge discrepancy in capital across markets, the sheer size of the capital that is locked up in the Mag 7. But that $70 billion that's coming out of Google, how much of that is going to go back into Google, go back into the Mag 7, or even go back into US assets? The weakness we have seen, albeit it stabilized this week in the US dollar, is still structurally indicating that the world is pivoting away from the dollar still. But these things don't happen in a straight line. And this week, the dollar has recovered and US markets have gone up a little bit. But coming back to the UK theme in all this, the FTSE is up in the last week by 1%, the FTSE 250 by something like 3%, and the AIM 100 is up 5%. So I think there's evidence that while we might not be seeing a deluge of this global capital, we stopped seeing the selling. And I think the feature of some of the smaller names that you and I follow in the UK market, it's definitely a feature now where companies, even producing bad news, share prices are not really going down much.
No, that's right. I mean, if we look at some of those smaller stocks, and I can mention a couple of the progressive clients this week, I think that bears that out. And in that broader context of potential capital flowing to the UK and prices already being bombed out, what we're seeing at the very micro level, the small end of small cap, is absolutely in line with that. We had 3 stocks reporting this week: Watkin Jones, Sanderson Design Group, and IG Design. Watkin Jones is a build-to-rent specialist, and they're active in the student accommodation market. They've had a very challenging couple of years. They put out a reasonable trading update for H1 to March, still talking about the market sounding pretty challenging and some difficulties that they're seeing. trying to be optimistic about the future, but it wasn't a uniformly upbeat update at all. And the shares haven't been too bad. They've been relatively flat across the week. The Sanderson Design Group, which makes luxury interior furnishings, got a big US business. They have a January year end. So they reported their FY25, which in itself was in line. No changes to FY26 in terms of the profitability forecasts. But they were also talking about significant challenges ahead. But again, the shares didn't respond negatively. And then finally, IG Design Group, which is involved in gift packaging and gift products of all sorts, again with a big US business. They gave us a trading update to March, and this was by far the biggest share price move. The shares were up, give or take 20% across the week. And the reason for that was they said that, yes, markets are challenging. They've gone through some significant cost-cutting programs across the business. Those are starting to deliver fruit. But the real surprise in the announcement was that the ongoing poor performance and difficulty in their US business has led them to accelerate their strategic review, which could even lead to a disposal of that business. So again, a UK-based company with global operations, they've seen challenges and pressures consistently for a number of years. They've responded and reacted, I think, pretty well. And the market has responded extremely positively to further news of sensible cost control, potential disposal, of dealing with the problem. And the shares are up 20%. So you can have really quite difficult macro and market news out there, but with companies doing the right thing, being sensible and just pushing through, you can see some really quite significant share price moves from where we are today. So that would be consistent with the UK market potentially being very attractive across the board if capital does start to flow out of the US or out of the Mag 7. And as you described, the scale of that capital is so significant, even a small proportion of it landing in the UK small cap sector would make a huge difference to us. So yeah, there are reasons to be optimistic.
It comes back to what we've discussed before, is that with the environment post-Brexit, the environment through COVID, all this chaotic uncertainty breeds resilience and the survivorship bias. If you have the right characteristics that breeds that resilience, and I would suggest the UK has had to evolve more than its fair share of that resilience over the last decade.
Yeah, it feels like it. Yeah.
Everyone hates us and we don't care. I mean, it's the Millwall theme again.
Right.
Yeah. But, you build an internal resilience, and I think that really does put our companies in good stead.
Yeah.
To your point of how the market is treating what on the face of it should be taken as bad news, I was drawn to Clarkson, the shipbroker this week. Mm-hmm. If you just read the update where they outlined the impact on the global shipping industry and the impact on asset values for what potentially is going down in this emerging trade war, you would have thought Clarkson was about to go out of business. It was pretty cataclysmic on first reading. And the share price went down, but it went down less than 10%.
Okay.
That was yesterday. It's up today, not by much. But, okay, the shares have been weak since the tariff wars have emerged. But this isn't a business that is suffering from an existential challenge. It's a business that is just pointing out that it's trading in difficult conditions.
Yeah.
And I think the market has reacted to that. And so far, it's almost just sort of shrugged its shoulders.
There's a strong argument. There's so much bad news priced in. And it's starting to feel like the UK environment, certainly from our political lords and masters, are they going to start to try and make things a bit easier for us as sort of UK PLC? Is there any sense of that might be starting to come through?
Well, there's always hope, isn't there? And I think maybe Jamie Dimon and Larry Fink's comments may be jumping the gun a bit. But this week we saw Tony Blair warn the government about its approach to net zero. And he did this on the eve of the UK local elections, which seem to have shown what everyone expected, that Labour will lose a significant number of councils and also the by-election. It's something like a 38% swing to Reform and away from Labour in the by-election. And that will not go unnoticed. And I just think that the Blair warning on the approach to net zero is not just a warning shot, but I suspect even a coordinated plan with the Starmer government to give them ideological air cover to U-turn on net zero, or certainly go much further to dilute the short-term impact of these net zero policies to stimulate growth.
Yeah.
And I think it's probably unlikely to happen quickly, but I think that is now on the cards. And I think that could be a major boost to the UK economy generally and to the UK stock market in particular.
Yeah. I mean, lower energy prices would be great, obviously, across the board, for both for consumers and corporates.
I think this sort of overall energy policy and the cost of energy is having a much bigger impact globally and geopolitically than probably is reported in the mainstream media or understood by most people. And I thought it was interesting that the Russia-Ukraine situation took a new twist this week, with Ukraine signing this long-discussed deal with the Trump administration over its mineral rights, which Ambrose Evans-Pritchard, who's usually pretty good on these things in the Telegraph, suggests that this is more about Ukraine's shale gas reserves than its rare earths. And this is happening at a time when Saudi Arabia is putting further deliberate downward pressure on crude prices. Now, over the past month or so, crude prices are coming down quite consistently. And the feeling is now that Putin is now going to be hit where it really hurts him. And with an oil price heading towards $50, which has been mentioned by Scott Bessent as a near-term objective, there is also currently underway a US proposal for very large primary and secondary tariffs, not just directly on the export of Russian crude, but on the countries who import that crude. Now, we know there's all kinds of difficulties of enforcing these sanctions, but the reality is that big movements in the oil price historically has very significant geopolitical consequences. And I think commentators are too focused on tariffs and being terrified, as Reuters put it, by what's going on in general world trade. And I don't want to downplay it. I think it is significant and we must bear in mind what's going on. But I think actually what's going on in energy pricing could be of more lasting significance. If you go back to when the Soviets invaded Afghanistan in the late 70s, they were able to do that because the oil price at that time, thanks to the Middle East oil embargo and the early innings of OPEC, meant that the very high oil price during the later parts of the 1970s boosted the Soviet economy such that it could afford to invade another country, and it did. And the withdrawal of the Soviets from Afghanistan in 82, 83 happened to coincide with an oil price that was briefly, at least, below $20 a barrel.
They couldn't afford to stay. Right. Okay. Yeah.
What did you know? A few years later, the Soviet economy collapses. And that was because the West found new areas for oil production, such as the North Sea and Prudhoe Bay in Alaska. So I think the oil price has become a manipulated price, or a price that can be manipulated. We know that. The two biggest oil producers and exporters in the world are Saudi Arabia and the US. And they have definitely been talking, and the oil price is going down.
Yeah.
And those are not uncorrelated events, in my opinion.
Well, lower energy prices would be great for everybody, except perhaps Vladimir Putin. So, see what comes over the coming weeks. What about the very short term? What have we got coming up next week, data-wise?
Well, later today, we got the non-farm payrolls, but into next week, it's about rate decisions. We get the Fed rate decision on Wednesday, where the expectation is for an unchanged rate at 4.5%. So watch out for the re-emergence of the slanging match from Trump, with Powell keeping his head down, no doubt. We also next week, I think on Wednesday, get the Bank of England rate decision, where we should be getting a cut from 4.5% to 4.25%. So keep an eye on the currency. Obviously, with a weaker dollar, the sterling dollar rate has been sort of up comfortably above the 130 level. So with lower sterling rates and unchanged dollar rates, be interesting to see what that rate does over the course of next week.
Okay. So lots to look forward to. We've got the bank holiday weekend in between, so hopefully people can enjoy that. And then, eyes on interest rates next week. And we'll catch up this time next week. Talk to you then.
Okay.
Thanks, Jerry.
Look forward to it.
Brought to you by Progressive Equity.